There is a lot happening in the real estate world. And right now, there's something that is affecting borrowers that I think caught a lot of people by surprise. It's something that we've covered on this channel quite a bit over the past couple of months. But again, since now it's hitting the mass media, more people are talking about it. So that's what we're going to talk about today. It has to do with these fees that are being assessed for folks with higher credit scores as opposed to the folks with lower credit scores. So let's kind of jump into it and we'll kind of tease this out fact from fiction and hopefully make sense of it for folks. The overarching theme here, and I don't want to make this political, this is not the intent of this. It's literally just to kind of go over this and make sure that you fully understand what it is and how it's going to impact you as a home buyer or if you are considering a refinance in your existing home. All right, so is there really a new unfair mortgage tax on those with high credit? Seemingly overnight, the internet is awash with regarding this new unfair tax on mortgage borrowers with higher credit scores. Some have gone so far to suggest that someone could potentially lower their credit score in order to get a better deal. Interesting. All right, let's just jump right down into it. This is news from January. Again, we talked about it before on this channel. We knew it was coming, but now that it's May 1st and the mainstream media has picked up, a lot more people are talking about it. It says, so low credit borrowers are already getting a discount while credit borrowers pay more. Not exactly. That's where the confusion comes in. Also, from here on out, please note that there's no opinion offered, blah, blah, blah. The fact of the matter is LLPAs are indeed changing in a way that improves costs for those with lower credit scores and increases cost for those with higher credit scores, in many cases anyway. But people are confusing the change for the actual cost. Then it says, so a low credit borrower isn't paying less than a high credit borrower. The gap between what they pay is just smaller than it was. Correct. That's like a Jedi mind trick. So if it's more money, it's more money. This isn't like relative to this. It's this article is, I don't know who was written by, but I think they've got their own personal leaning on this. Says, yes, again, all value judgment, political commentary aside, the change amounts to a tweak of an existing fee structure in favor of those with lower credit scores at the expense of those with higher credit scores. But there's no scenario where someone with lower credit will have a lower fee. In other words, don't go skipping those credit card payments in hopes of getting a lower rate. True, you are not going to get a lower rate, but you're going to pay less in fees. All right, let's look at these charts real quick. I'm not going to deal with these cash out refis. Instead, let's just look at these purchase loans. So you can see here, the fees are dropping by like 2%. And if you have a less than 620 credit score and you're putting down less than 5%, you stand to benefit the most. Whereas the people who are kind of in the middle here with, the mid-tier credit, 720 to 760 looks like, with about 20% down. So those folks who have been responsible, they're getting crushed, right? With 3/4 of a point additional in fees. Over the course of a 30-year loan, this equates to like $15,000. It's a huge amount of money. And these numbers seem small, but in reality, when you forecast it out and you do the math over a 30-year period, it's a massive, massive hit to a lot of these folks. But this is showing down here in purchases outright. It's basically showing that, even these people with these low credit scores are going to pay significantly more in interest than someone with a high credit score. But that still, that's common sense. What doesn't make any sense to me, and let me know down in the comments whether you agree with me or not, is we're essentially rewarding people for, I'm not going to call it bad behavior, but for not behaving responsibly when it comes to your finances. Now, there are some, of course, big exceptions. Medical bills is the biggest one, where a lot of people who have medical debt, unfortunately, that shows up on a credit report as well. But again, a lot of these folks, they have no business buying a home. If you have a sub 620 credit score, you probably should not be buying a home, because even if you can scrape together enough money for the down payment and you close on the home, owning a home, there is a lot in any given year, you're paying a ton of money just to properly maintain and operate that home. This is just not a good situation where you're encouraging people or you're incentivizing people with poor credit to go out and purchase homes, which is a real disservice to them and it's a real insult to those folks who have done the right things, saved up, 20%, and they've managed their finances properly. And what are they rewarded with? Additional fees at the expense of people who haven't behaved that way and gotten incentives. So the other thing I want to talk about here is what this is going to do to the market, right? The real estate market in general. If now all of a sudden we are introducing more people into the mix that are now qualified buyers, there's already a shortage of houses out there, especially, I'm here in the Boston market, and the number of homes, we just don't have enough homes to sell. So you're seeing on most properties at this point, if they're competitively priced and they're in decent condition, you're going to see an opening weekend anywhere between 5 and 10 offers on the place, many of which are 10, 15, 20% over asking. So when you introduce another whole segment of buyers into the pool, what's that going to do to home prices? It's going to continue to drive them up. So in an effort to get folks into home ownership, it's going to have the exact opposite effect. It's going to make these homes less affordable because there's more competition in the market, and more competition, more demand drives up home prices. It's like, I'm not the brightest bulb, but I can see this stuff in plain sight, and I feel like there's a lot of folks out there on the policy side who just don't think some of these things through. So anyways, those are my thoughts. What do you think of all this? Is this, is this good? Is this bad? Are you indifferent? Do you care? Does it sting a little bit if you're a borrower and all of a sudden you're paying a little bit more to help offset some of the costs for somebody who is not as qualified as you are? How does that sit with you? I'm curious. Again, let me know down in the comments below. If you did enjoy this video, I just kindly ask to just smash the like button and also click the subscribe button down below to be notified of future videos. Thanks for watching. Take care.